This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, and Bloomberg Originals.
And a very good afternoon, everybody. Yes, indeed, across Bloomberg platforms. He is back.
Are you talking about me?
I am.
Or Charlie Pellet?
Well, Charlie's been here.
Charlie's here.
I mean,
but he's
love you, Charlie.
He's a world traveler.
He is a world traveler, but it's good to have you.
It's good to be back. And I tried to unplug a little bit. I couldn't,
Good.
I couldn't stay away from everything. But I come back and it seems like we're talking again about the Strait of Hormuz and oil prices.
It's amazing, right? You kind of can't get away from it. Yes, indeed. We do have President Trump saying the U.S. would restart its blockade of Iranian ships through the Strait of Hormuz. There's that going on. And then again, Tim, and you know that before you went on vacation, we're questioning this AI-fueled trade. And some days investors are buying in, some days they're not. And you see that play out in particular among the semiconductors.
Yeah, especially in Korea. So like overnight, what happens in Korea and then that bleeding into the U.S. a little bit, certainly happening with SK Hynix shares dropping. Investor concern about this boom being potentially overextended.
It's the big question, right? And I guess only time will tell what actually is going on. So we're just going to all have to be patient. In the meantime, ahead this hour, we are going to take a look at semiconductors, SK Hynix in particular. You've also got some news out of TSMC, the ups and downs of chip stocks. What do the fundamentals show? That's what we like to know. I'm looking at a SOX, though, that's down another 5% in today's session, but we continue to see this group up and down, up and down. We're focusing on those memory names. All 30 names in the SOX down right now.
We're also focusing on earnings as we do start to hear from the big banks this week. It'll be watched by investors. The deal environment, too, in question. Mitch Berlin over at EY Parthenon, EY Americas, also Bloomberg News, U.S. IPO and deals reporter Ryan Gould. They're going to sit down with us in just a few minutes. We'll talk about deal activity ahead of the midterms on a day two when states are challenging the Paramount-Warner Bros. tie-up.
I was going to say, uh-oh, not completely done. All right, plus Rodger Crandall, CEO over at MassMutual on health and wealth colliding, and then tying it all together. We've got a great investment guest, Julie Biel at the alt investment firm Kayne Anderson Rudnick, coming our way in just a moment.
All that ahead over the next hour right here on Bloomberg Businessweek Daily. First up, though, a check of the day's trade and top business stories. Here he is, Charlie Pellet.
All right, I thank you very much. Welcome back, Tim. Nice setup because you guys hit all the key elements that's going on. Lots of moving parts to this market right now. Gold below $4,000. Oil is surging. Chips selling off. Stocks are lower. So let me begin with what is happening first of all with spot gold. It is at $3,994 on the precious metal. Gold is down by 3.1%. Crude now surging by 8.5%. WTI back above 77.53 right now. Barrel of Brent crude is at $82.54. Brent up now by 8.6%. All of this as oil investors, keep an eye on developments out of the Middle East. Stocks lower, tech names hit hard, semis particularly hard. The SOX, the Philadelphia Stock Exchange's Semiconductor Index, down now by 4.6%. The NASDAQ 100 Index down 1.8%. The NASDAQ Composite Index down 1.4%. All of this with the S&P 500 Index keeping us in context, down 51, a drop there of 0.7%. Dow Industrials down 136 on the Dow, a drop there of just about 0.3%. The 10-year at 4.61% with the 2-year 4.26%. An AI-fueled stock rout in South Korea spilling over into U.S. markets this morning. SK Hynix ADRs now lower by 6.4%, underscoring growing investor concerns that the boom is overextended. It is a topic that we'll have a whole lot more on coming up here on Bloomberg Businessweek Daily. Micron, among some of the other memory names, down 4.9%. SanDisk down 12.4%. Western Digital down by 6.6%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. Tim and Carol, that is a Bloomberg Business Flash.
It is indeed. All right, Charlie, thank you so much. Well, semiconductor cycles are to be expected. That's the industry kind of mind think that we are so often reminded about. We've seen that certainly in the stocks in the space as they rally and sell off. The group overall is certainly up a lot. But take SK Hynix today, just one trading day after the shares started trading in the U.S., and we're seeing that name getting pummeled.
Yeah, down about 6.3%. These are ADRs
Correct.
Here in the U.S., and they're down about 6.3%. But I think a lot of people would argue this is the sort of the epitome of a cycle, right? That's the chip stocks are what represent where we are in a certain cycle. Like, people have seen this movie before.
Listen, one of the questions we kept asking last week and also on Friday is like, is this a sign of the top or possibly a sign of, wow, another just major cycle, upcycle that maybe goes on longer rather than shorter when it comes to semiconductors? We've got a great voice with us.
Ian King is with us. He's Bloomberg News U.S. semiconductor reporter. He joins us from the Bloomberg News San Francisco bureau. This moment in time, Ian, for somebody who lived in Korea like you, covered these companies in the U.S. and globally, what does it represent to you?
It's very difficult to know. I mean, I think you have to separate what's going on in terms of the trading and in terms of the general market nerves with the fundamentals. All we can say, as somebody who covers the actual companies, is that there is nothing that has happened between last week when everybody loved SK Hynix and today when, oh my God, we're scared and it's the end of the world. For example, there was a report by Mizuho out there saying that data center spending is actually going up. And guess what? The even better news is that it's spreading out to neoclouds, to smaller companies, that there's less of a concentration of risk. So, separating the two, the trading situation and the actual fundamentals is difficult right now.
Less of a concentration, great, but still risk, perhaps. I mean, this is the thing we've got to figure out, right, Ian? I'm looking at a bunch of headline stories. Cameron Kreis writing the AI chip trade is starting to look a little ugly. We've got the Kospi slide overnight, circuit breaker cushioned by TSMC sales because there was some good news there. We also have questioning whether or not the SK Hynix debut, as Tim mentioned, is a bet that the AI breaks the boom and bust chip cycle. I mean, do we know? How will we know? Will we not know until there is either signs that this is a boom that lasts longer or a sign that there is actually a bust starting to happen? Will we not know until we're there? Yeah,
it tends to happen fairly quickly, particularly in the memory chip industry. So you would definitely, that explains why people are twitchier about SK Hynix, Micron and Samsung, because the commoditized nature of these, but none of the fundamentals that we've got indicate that there's any turn there. In general, you would look at margins starting to slip, utilization of factories starting to slip, of pricing power starting to slip. At the moment, we haven't seen anything that would indicate there's anything going on in those metrics.
Ian, why aren't there upstarts that come in and try to make money quickly off a situation such as this, off a boom such as this?
What would you say if I asked you, can I borrow $30 to $40 billion and the return on that will probably not be very good, so then I'll need another 30 or 40 billion to maybe do okay, and then maybe another 30 or 40 more after that.
I would say
just be okay.
So what you're saying is you got to spend money to make money?
You've got to spend a lot of money to make money, and there is really very little in the way of a guarantee of success. It's really difficult. That's why we don't see people crashing into this market, because the barrier to entry is so high. I mean, in terms of design, it's become more automated, something that can be done faster. But again, you've got to get to volume for this to make sense.
First of all, I love when Ian King does sarcasm. It just kind of warms my heart, especially on a Monday. Having said that, I mean, all of the names in the stocks are down here, and this index still up, I don't know, more than 70% year to date, but it's been up a lot more this year. We have seen certainly, some pullback from some of those highs. Ian, what is it though about memory chips? And you remind us, I wrote it down, I have it actually on my desk, where it's like, was it 3 years ago that the memory guys, right? They were just in the dumps. What is it about memory? Is it something more particular within the semiconductor space that's worth noting here?
Yeah, I mean, the word commodity is appropriate because, in theory, if you take a DRAM chip made by Hynix, you pull it out of your computer, throw it away, and grab another one from Samsung, put it into the slot that you took the Hynix chip out of, it's going to work because they're made to industry standards. Therefore, they can be traded. Therefore, supply and demand. In theory, there isn't the technological edge between one company's products and another. They are replaceable, so they're a commodity, and you can buy and trade and play that supply and demand balance. And that's what's always been the case. So they tend to sort of move and be very responsive to that demand and supply balance. And once that tips, it tips really fast, and these companies can lose money.
What does our audience need to know about Chinese memory chip makers?
So far, they haven't been a factor, and the reason that they haven't been a factor is because of the attempts that the US government has made to restrict the access of advanced technology, whether it is the manufacturing technology, whether it is the actual chip technology itself. These companies that have tried to get into this industry that were potentially going to flood the market with supply and bring it back down haven't been able to do so because they can't get things like ASML's latest machinery. Whether that will change, whether the lobbying efforts of some US companies to bring them into the market to address this supply situation will change that dynamic, but we don't know yet.
Hey, before we go, 30 seconds if we can on TSM. That stock, the ADRs that trade here are down about 2%. They were a little bit higher, though, in the session. Sales soaring 36%. Our story saying that in the latest sign of AI spending momentum. What does that story tell you about semiconductors? Or other names?
I mean, it's an affirmative story in that obviously they still have a lot of demand. Everything that's leading edge, everything that's really expensive is going through their plants. The thing to watch, though, is their revenue going up because of margins, because they're able to charge more versus more volume of orders, and that I think is something that people should focus on.
Yeah, you always point that out, which is really key. All right, Ian, thank you. As we said, we always appreciate Ian King, Bloomberg News, U.S. semiconductor reporter out there on the West Coast. Tim, we know we're watching the semi-trade. As we mentioned, the Philly Semiconductor Index, all 30 names are down into today's session, still up more than 70% year to date, but there was a point where it was up more than 100% this year. So we've definitely
only July.
I know.
I'm saying that both ways.
A lot can happen. All right, let's get to it. Investors, too, are watching, as Tim mentioned earlier, all the developments in the Middle East. That continues, the churn, what doesn't look like, we're making progress there. Julie Biel is CFA, Chief Market Strategist, and Portfolio Manager at Kayne Anderson Rudnick. They're an alt investment management firm. They focus on real estate, credit, infrastructure, and energy. They've got about $38 billion in AUM. She joins us from LA. Julie, thanks so much as we kind of got through some of the day's chip news, because this seems to really move the market. I don't know, what are the market stories? What are the geopolitical stories? What are the stories that really matter to you in your investment world?
I think that there's two separate things, right? In our investment world as bottom-up investors, we're really just focused on the individual names themselves, because the idiosyncratic qualities of them, particularly in small and mid-cap, are much more important necessarily than the broader macro. But for the market, in the here and the now, it's really the two themes of what does the change in the geopolitical tension mean for inflation, oil prices, et cetera, and what is the durability and the sustainability of the AI CapEx cycle. And so I think these two themes are really central, and there's good reasons for that, right? We know that it would be wonderful to have lower interest rates. It's just hard to do it when inflation has been this persistently sticky. And we also know that a large amount of the CapEx spend that's happening is really taking over for consumer spending. It's been the longest time in the world that I've been saying, well, the consumer accounts for 2/3 of the economy, and that's really kind of changed hands recently. And so that means that this theme is what's driving our economy and supporting it, at least in the here and now.
Well, let's start with one of the hard questions that you posed, and that's the one that everybody's trying to figure out, which is the durability of the CapEx spending when it comes to this AI infrastructure. I think it's fair to call it a rally still at this point. What is the durability of that spend?
I think the biggest challenge that we have is that the way it is panning out right now, when companies are integrating a lot of these AI tools, some of them are generating a ton of benefit, and that's primarily the software companies themselves that are using it in their software development. And the question I always have is, what does it mean when the company's selling you the technology? Are they themselves the best use case for it? But does that necessarily translate into better sales for the rest of us? And I think that's the ongoing question, particularly as token prices, continue to be a larger and larger part of IT budgets and are harder and harder to control. So I think that's an ongoing question. And then on top of that, if we have higher prices for memory and circuit boards and all of that, then that changes the investment case case, it makes it even harder for them to make money because putting in the data centers themselves just gets more and more expensive. So I think we're kind of in this air pocket, this moment where the economics still aren't really clear and the use cases themselves haven't panned out, I think, the way that people had hoped.
Hey, one of the things I want to ask, and what's interesting about talking with you, Julie, many things, but I also like the world that you play within. Sorry, you know what I mean. But I mean, infrastructure, energy, which is something, real estate, actually, when you think about AI and the build and so on, what are you seeing there that supports what feels like the over demand that we continue to see in this? Or do you feel like things are kind of calming down a little bit? What are you seeing?
I think we still would expect that there would be continued demand for these data centers. What's really difficult, though, is that they have a pretty bad rap, and so there continues to be a lot of community pushback. I think there really hasn't been a very good use case made to many communities that are receiving these data centers for why they might be positive or not. And so I think that that friction creates a certain amount of ceiling that's very hard to break through in terms of continuing to expand the growth. That might not be a bad thing. That might mean that that is the thing that prevents us from having a full-out bubble because we're really capacity constrained, and so we stay a little bit more capacity constrained, and we don't reach, a rational exuberance. It just takes time to really filter through.
Until we send them to space.
Until we send them to space.
I mean, I'm only joking. I'm only half joking here because that is Elon's thesis and many others' theses at this point, that like this is something that could be done in space. Is that realistic to you?
I think the science still has to be figured out. I think we are thinking about it less in terms of, I think people imagine these, large scale deployments. And I think what they're talking about more is racks in space. And I think maybe it's possible that for certain use cases where latency isn't an issue, that's a good opportunity for us. It's just you have to factor in that anything that goes up there has to be radiation hardened to a pretty extensive degree that we haven't yet figured out that kind of technology. And so that may take a little bit longer than people are expecting, but I think it's a possible use case. We can't just completely count it out.
Do you look at the markets right now as a case, Julie, where so many things have to go right for all of this exuberance? I'm going to go ahead and use the word exuberance and excitement about AI has to pan out? Or do you feel like, wow, it's really amazing. Here we are getting ready for another earnings season. We're probably going to once again see the CapEx and the justification, and the fundamental stories are going to be there that support the AI build.
So personally, I think it's a little bit of both, where I think that the CapEx benefits that we have going into the economy, that's really benefiting a lot of people and a lot of companies in the here and now. We're not just seeing it on the chip side, but we're seeing it in HVAC companies that are really benefiting. And your average electrician is probably really enjoying this surge in demand for his or her skills. So I think that there's an immediate impact in the here and now that investors are chasing. And that's not even just on the semiconductor side. I think we see it across a lot of even small cap industrial names where people are really chasing the picks and shovels right here, right now. And that's based off of a pretty rational assumption that that's going to continue and that the earnings growth is really strong. And so while I question the durability of that, I wonder how much we can kind of continue to build out at that level. And then, I think if we think longer term, the technology for sure is going to be impactful.
Good stuff. Come back soon. Julie Biel. She is Chief Market Strategist, Portfolio Manager at Kayne Anderson Rudnick out there on the West Coast.
Hey, coming up next, states are suing to block the Paramount-Warner Bros. Discovery deal. That and the busy M&A world overall. That's when Bloomberg Businessweek Daily continues.
It's 2:21 on Wall Street. We do check markets all day long. Here at Bloomberg, we've got equities very close to session lows right now. The blockade in the Strait of Hormuz. It is now on. Just getting official word. U.S. Central Command says the U.S. will resume the Iran blockade tomorrow, 4 p.m. Eastern Time. The blockade will be against vessels going to and from Iranian ports. Military says it will continue to support traffic through regional waters. But again, just getting word from U.S. Central Command that the U.S. is resuming the Iran blockade July 14, 4 p.m. Eastern Time. The Dow, the S&P, NASDAQ, all in the red right now. Stocks and bonds are falling. Oil is jumping. Got to begin with crude because it is now higher, up by 9.6%. WTI, $78.29 a barrel. Barrel of Brent, the global benchmark, $83.35. It is up by 9.6%. Oil is surging as the standoff between the U.S. and Iran intensifies. Stocks lower. S&P now at 75.17, down 57, down 0.8%. Dow Industrials down 0.3%, while NASDAQ is down 1.5%. Tech names hit hard today. NASDAQ 100 index down 1.9%. This with the SOX now down by 4.9%. 10-year 4.61%. The 2-year 4.27%. Spot gold $39.90 the ounce, falling below 4,000 an ounce of the precious metal, now down by 3.1%. Again, recapping the Dow, the S&P, NASDAQ, all lower. S&P down 0.8%. Crude, the big story at this hour. Right now, West Texas Intermediate crude up 9.7%, $78.35 a barrel. I'm Charlie Pellet, Carol and Tim. Lots going on. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie Pell. Just to reiterate a headline that we just heard from Charlie, U.S. is to enforce a blockade of Iranian ports from July 14th at 4 p.m. Eastern Time. That's tomorrow, just a little over 24 hours from now. Charlie mentioned the move in oil that we're seeing. Brent up $7.36. It's 9.7%, up to $83.37 a barrel. WTI higher by up to $78 a barrel. That's up by 9.6%.
All right, we'll keep an eye on it. We're also watching M&A in a big time. There's a lot of activity going on. We're going to get to that in just a moment. But what we did see in terms of actions today, a group of 12 states suing Paramount Skydance, seeking to block its $110 billion bid to buy Warner Bros. Discovery, alleging the deal would leave viewers with higher prices and fewer choices for movies and television. Weighing in on it today, FCC Chairman Brendan Carr, earlier on Bloomberg Tech with Ed Ludlow.
Well, it's hard to see a real legitimate antitrust action, but of course, I leave it to the antitrust experts to weigh in on this. I did think it was interesting that there was a statement, at least attributed to the California Attorney General, that said that they would not sue if Paramount agreed to spin off CNN. It's hard to conceive of a competition or antitrust theory that takes you all the way up to the point where owning or not owning CNN as part of that broader group is a legitimate line that antitrust or competition law would draw. For our part, we do have a piece of this with respect to some of the foreign investment, and we're running a standard process on that, and we haven't made a final decision there yet.
That was FCC Chairman Brendan Carr earlier on Bloomberg Tech. Paramount responding in a statement saying, quote, "The lawsuit filed by the state attorneys general in the most generous light reflects a fundamentally flawed application of the antitrust laws and is wrong on both the facts and the law. This transaction creates a stronger competitor against dominant streaming and technology platforms who have harmed the market for theatrical exhibition and jobs in the entertainment industry. This merger will create a company capable of investing more aggressively in premium content, theatrical releases, and creative talent at a time when those investments matter more than ever."
All right, we want to know more on this lawsuit, what it's about, the legal merits of it. With us is Bloomberg Intelligence Senior Litigation Analyst for Antitrust. She is Jennifer Rie, and she joins us here in studio. All right, Jen, good to have you here. What's the legal justification of this antitrust suit, and what are the merits of this case?
So what they're alleging here, the 12 states that sued, is that in three different markets, 2 related to movies and 1 related to the package of basic cable assets that this combined company would have, that the combined shares get to close to 30% or exceed 30%, but also there are concentration numbers that come out of those markets that exceed the thresholds that are in the merger guidelines the Department of Justice uses and would suggest that this deal could cause harm. So it's pretty straightforward. They're looking at top-selling movies, they're looking at widely released movies, and they're looking at the licensing of basic cable channels.
Is there precedent where states have come out against federal regulators and states have actually won?
More recently, there is, yes.
Yeah.
I mean, look, the states have always been able to enforce federal antitrust laws as well as their own state laws. And they have, in some cases in the past, gone their own way independent of the FTC or the DOJ. They are doing this more and more during this administration, and they said they would. When Trump was reelected, the state said, look, if the DOJ and FTC get lax on antitrust enforcement, particularly in the merger area, we're going to step up and we're going to exert our independent right to go ahead and try to challenge some of these matters.
So Paramount's response, which Tim read, saying, and it's a lengthier response, it's, you guys can find it, it's out there, but saying the lawsuit reflects a fundamentally flawed application of the antitrust laws and is wrong on both the facts and the law. Is Paramount right?
Well, look,
or is that just a response?
I think it's just a response, and it's a very broad statement. You know, it gets down to the nitty-gritty. These matters are fact-based. They're very detailed, and it's about how the relevant markets are defined. The states have defined the relevant markets one way. I'm sure Paramount would say that's all wrong. Those are not the proper way to look at the way we compete. That's what they mean when they say they're wrong on the facts and the law. And that's going to be a main argument in this case. Are these markets defined properly or not? And if they are these shares correct or not? And do they depict a deal that could cause harm? I have to say that even in the markets the states have defined, which are narrow, which they had to do in order to push the shares up, the shares are very close to being borderline. They barely exceed those thresholds that suggest harm from a deal. So this is a close case.
What are the probable outcomes here, or at least like a timeline for outcomes?
So what the states are going to have to do still is file for a preliminary injunction, because right now the companies can't close their deal. They're waiting for UK and they're waiting for the European Commission to decide. But once those two regulators come through, and I think they probably will clear the deal eventually, they have no legal impediment to closing. And once they've closed and they've integrated, it's highly unlikely that these states can convince a judge to unscramble the eggs and force them to unwind. So as we get closer to a UK decision, which may be later this year, they're going to have to get a preliminary injunction.
Help me with what FCC Chair Brendan Carr said. California Attorney General said that they would not sue if Paramount agreed to spin off CNN. It's hard to conceive a competition antitrust theory that takes you all the way up to the point where owning or not owning CNN as part of that broader group is a legitimate line that antitrust or competition law would draw.
Well, I'll say a couple things. First, the California State Attorney General, Rob Bonta, to my knowledge, just a few days ago, made a statement that he hadn't said anything like that. Now, if he has, and I have missed it, that's fair.
Okay.
But what he had said is that isn't something. I don't know why people are presuming we want CNN to be divested. But on the other hand, one of the markets they've alleged, which is the licensing of basic cable channels to distributors, there are retransmission fees that are paid by Comcast and DirecTV and companies like that are paid for these packages of cable channels, will go up by virtue of owning this giant package of cable channels. CNN is in that package. And if the answer is the remedy there is to divest some cable channels, CNN could be one of them. So it doesn't lack merit.
Last question. Is this a case that you think is going to go back and forth for a while? They're going to be settled? And is this deal going to ultimately get through? Right now, we had showed earlier shares of both Warner Brothers and Paramount were higher today.
Well, I think that this is going to go back and forth for a while. I think the UK is going to hold things up for some months and give the states some cushion here to try to get a preliminary injunction. It puts Paramount in a tough position because they have a ticking fee that kicks in on October 1st, 25 cents per shareholder per quarter for Warner Brothers. And they're not going to like that. So I suspect if a preliminary injunction kicks in, there may be some settlement viable down the road, because I would suspect Paramount's probably playing hardball right now because they think this is a weak case.
God, it's so much fun. I mean, I can't wait until we say a streaming series comes out on just like the.
It's a little too meta.
It's a little too meta. My next life, I want to come back as Jen Rie. I'm just going to put it. Bloomberg Intelligence Senior Litigation Analyst for Antitrust. She is Jennifer Rie, joining us here in studio. All right, I'm Carol Massar, along with Tim Stanovic. We're going to continue to watch this. As we said, both share prices are higher. But one of the things we want to do, what we have noticed is that M&A, Tim, seems to have come back in a big way. We are seeing deals in the healthcare space. We're talking about this. There's just a lot of activity going on right now when it comes to M&A, and it may have been coming from some low levels perhaps year over year, but it is back in a big way in the US, in North America, and globally overall.
Yeah, I'm glad you went with the regional breakdowns, because those are important here, because it's not everywhere where we're seeing the same sort of boom. M&A up globally 39% year over year. Activity in North America, actually, deal activity is up more than 63% from just a year ago. So here in the US, really leading the way.
All right, so we want to get to it and get a look at what's going on, why. Joining us right now is Mitch Berlin. He is EY America's Vice Chair at EY Parthenon right here in studio. Good to have you back. It's been a bit.
It has been.
Nice to have you here. And joining us for the conversation, I'll tell you why in a minute, out there in our Washington, D.C. bureau is Ryan Gould, Bloomberg News U.S. IPO and Deals reporter. And, Ryan, I kind of want to start with you, and maybe we'll get in also to Paramount-Warner Bros, the back and forth. But you and I were stepping off the elevator here on the 6th floor at Bloomberg. I'm like, how's it going? And you're like, I am so busy. And so give us the backdrop of what you've been seeing in terms of the deal activity and what's going on.
Carol, it's great to be back. And what I would say is maybe at the top here, we're just talking about Paramount. Perhaps there has never been a better time to be a friend of the administration. I think if you just look at the various permutations that surround that deal, you think, it's been cleared in the US, it's now coming under challenge from the States, it's under challenge in the UK. I think if you just extrapolate across the picture here and look at how antitrust is being viewed just generally, I think you're looking at a period right now where there's never been a better time to be a friend of the White House. There's never been a better time to sort of be thinking about your dream deal. I think generally right now we are in the midst of a Trump-induced M&A boom, and I think you're seeing this across the piece, right? You look at deals like NextEra or Dominion. I mean, that's a huge transaction that touches on power, it touches on AI. You think about deals in the media space outside of Paramount like Fox Roku, that's a big deal that perhaps you might not have expected to have seen in another world of antitrust enforcement. Mm-hmm. And I think just generally, if you go into a boardroom, you're looking at boards and management teams and their advisors who are saying, guys, it's here for the taking. Let's have a discussion about what you want to do, what you think your business will look like. And, let's talk through that.
Yeah, Mitch, come on in on what Ryan is talking about. How much of this is about the administration right now versus about the environment that is sort of distinct or at least separate from the political tailwinds?
I think it's a combination of the two. Certainly the FTC and DOJ has been very deal friendly. I think they've only got in the way of one deal that I think has been renegotiated but not stopped, which is sort of precedent setting. But I also believe that companies need to transform themselves, and the quickest way to transformation is through a transaction, inorganic transformation through M&A, and that's why you're seeing so many deals happening. The fact that these large deals are happening, just this month alone, in June alone, I think there were probably 7 deals over $10 billion, just shows you how bold companies and boards are being, knowing that they're probably not going to get stopped by the FTC or DOJ.
Is there, though, Mitch, a bit of a march to the midterms and thinking about, okay, the environment could potentially change out of D.C., and so if you're looking to get a deal done, let's do it now?
I think that could be part of it as well. Certainly people know that the whole world can change in a couple of months during the midterm, so let's get in now when we know it's a sure thing, more or less, versus take a chance and see what could happen 6 months from now with a new potentially leading House and Senate. Yeah,
same question to you, Ryan. I mean, how much of this is about getting in under the wire, making sure that the Congress, you're in Washington, D.C. today, but making sure that the congressional makeup is one that is conducive to deals moving through?
I really don't think that can be sort of understated, because if you think about some of these large transactions that, look at Paramount. I mean, these are deals that could have a period of antitrust review that could total somewhere in the region of 18 to 24 months. If you think about the fact that we're about to head into the midterms where you could see the House or the Senate change hands, you're sort of thinking about now what that timeline looked like if we were to be going out tomorrow and announcing a politically thorny deal. You don't want to be necessarily running up into that period to end up having to pay things like ticking fees in the case of Paramount, Warner Brothers, and I think just generally, if you're a company that's sort of staring down the barrel of an AI threat, right? You're thinking about how do we not want to be left without a dance partner here. This is an epoch-changing time for many of these companies, and I think they're looking to be aggressive. They're looking to be on the front foot. And you go out and talk to any banker or lawyer, and I think they're saying, the antitrust environment is perhaps one piece in a cog of many other factors. The proximity of the midterms is one of those things too. But just generally, we're looking to be on the front foot, and we're ready to act when it's necessary.
Mitch, come on back in here. I mean, you talk about companies, probably facing it's innovation, disruption, whether it's AI and so on and so forth. What is primarily the driver? Is it AI connected, or is it just for drug companies? It's looking down their pipeline, what's typical for that industry? What is it?
It's sector specific. A lot of it is driven by AI. Some of the front of the house AI, but a lot of it back of the house AI. So when you look at a lot of the deals that are happening in the tech sector, it's AI infrastructure. So it's the data centers, cloud computing, the energy companies that are providing energy to AI. So all that is AI related. But when you look at life sciences, for example, there's about $400 billion of patents that are going to go off patent in the next year or so. So that puts around, that's a significant, or maybe it's the next 3 years, I'm sorry, but that's a significant amount of revenue that you have to replace when you start having generic drugs. And so that's what's stimulating a lot of the life sciences M&A, in addition to or the orthopedics, or rather the oncology drugs as well.
We see a lot of that. Ryan, come on in. You know this world too. Come on in, maybe with a question for Mitch.
Yeah, I mean, I think one of the things I would just add on top of that is, you think about what we've seen over the past 6 to 12 months, it's been really dominated by the corporates. And one of the quotes, I mean, we were surveying sort of for our sort of half year look back at the, what the M&A that happened over the past 6 months. And we spoke to one of our friends at Goldman Sachs in Europe who runs the business there. He said that, we're seeing so much corporate activity because they're not buying for the next 5 years. They're buying for the next 40 to 50 years. And I think that really gets at the heart of some of this, right? Which is that this is really, we've never been in this period before, where companies are going to have to take such big steps, and they're going to have to become very, very familiar quite quickly with what this new normal would look like across M&A.
Right. If you look at the first 6 months of this year, the majority of the deals have been corporate deals. I mean, an incredible year for M&A, $3 trillion. Globally, 70% of that is in the U.S., but the majority of that is the corporates versus the private equities. A lot of it because the cost of capital is high. We have a deal barometer that we put out. We update every quarter. We're expecting PE to be flat this year because of that, and they're actually negative going into the first 6 months in terms of deal volume.
That's interesting.
But overall should be flat this year, which means the second half of the year should be big. But the corporates definitely are on an uptick. We're expecting about an overall 11% increase in volume from corporate activity this year in the U.S.
One of the other things I would just throw in the mix here, just as we think about the makeup of the M&A that we have seen, you also should think about the deals that haven't happened. If you look into Europe, I mean, we followed a deal quite closely earlier on this year where Pernod Ricard, the French beverage giant, put in a bid for Brown-Forman, the maker of Jack Daniel's whiskey here in the US. That deal fell apart. A variety of reasons, but two family shareholders, cross-border M&A is difficult. Another reminder came when Estee Lauder, the great large beauty company, globally tried to sort of merge with Puig in Spain. Again, another family shareholding issue there that perhaps led to that deal falling apart. But I just think that gives you some of the sense of the scale that we're seeing across the piece here. And I really don't think I think it's important not to underestimate just how big companies are looking when they're thinking about M&A today.
Mitch, just because a deal happens or we're in an environment where a lot of deals are happening doesn't mean it's ultimately a great thing. I mean, we can think back to the year 2000, and AOL Time Warner is sort of the textbook case of a mega merger that went completely wrong. When are we going to know if this era was one that was full of successes or one that was full of missteps?
I think the level of diligence that people are doing right now is so much greater, and the access to data that we have is so much greater than it was in the past, that I wouldn't expect as many failures. From a mathematical perspective, the culture is always an issue. But mathematically, I think the deals and the synergies make more sense now. They're doing much more than they had in the past. You always have to get the culture right. And if you don't get that right, the deal can fail. And that's something that you can't necessarily get through, diligence and crunching the numbers.
I've definitely heard that from top M&A bankers. Like the CEOs have to get along for this deal to make sense. As a sign, indication of market health, economic health, global business health, what does it tell you in terms of the activity that you're seeing and the types of deals being done, just as we wrap up?
I think the capital markets are really strong, and that's funding a lot of these deals because the corporates have strong balance sheets. So it's easier for them to do deals. I think the CEOs and the boards also know that this calm that we were expecting a year ago is probably not going to happen. And so this new sort of environment that we're in of not knowing what tomorrow holds in store is sort of the new norm. And so people are just getting much more comfortable with doing deals amidst chaos.
Are you allowed to take vacation?
Not yet.
Okay. That's always telling. Mitch, great to have you back. Come back sooner. Not so long. Mitch Berlin, EY America's Vice Chair at EY Parthenon, joining us. And of course, thank you, Ryan Gould, out there in our DC bureau, typically in New York, but in Washington today. He's Ryan Gould, Bloomberg News U.S. IPO and Deals reporter, joining us.
Hey, we got Charlie Pellet standing by in the Bloomberg Businessweek studio. He's got an update on these markets and certainly an update on oil. Hey, Charlie.
Well, hello there. Yeah, Tim, let's begin there because we are seeing a major move in West Texas intermediate crude. Right now, WTI up by 8.7%, 77.58 where we stand on WTI. Barrel of Brent crude, 82.68. Brent crude up by 8.7%. Stocks lower, oil higher. Investors are assessing a tense situation in the Middle East. President Trump reinstating the U.S. blockade of Iranian ships transiting the Strait of Hormuz. CENTCOM says this will happen 4 o'clock Wall Street time tomorrow. The Dow, the S&P, NASDAQ very much in the red right now, with the S&P down 51. Drop there of just about 0.7%. Slight bounce off the bottom, but close to session lows. Dow Industrials down 149 on the Dow. Drop there of 0.3%. NASDAQ down 1.4%. The NASDAQ 100 index down 1.8%. And the Bloomberg Max 7 index up down by 0.6%. The VIX just below 17 now. The SOX selling off. The Semiconductor index down now by 4.8%. Gold, as I mentioned, $39.99 the ounce. Spot gold down by 2.9% now, with a 10-year 4.61%. Crude bears repeating, up 8.7% on WTI, 77.51 a barrel. Briefly, a federal appeals court has revived lawsuits that claim Kenvue hid alleged risks that Tylenol could cause autism in children whose mothers took the over-the-counter pain medication while pregnant, a controversy that has roiled the medical community. Shares of Kenvue today, they're down 1.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Carol and Tim, that is a Bloomberg Business Flash.
Hey, Charlie, thank you so much. Watching, of course, as energy prices once again spike higher because of the Middle East and the tensions there. So keeping an eye on that for you as we work our way through this hour. I want to take you back to 1851.
Okay, I'm listening.
Millard Fillmore was president.
I think that was the first Millard Fillmore reference on Bloomberg Businessweek Daily, but go ahead.
Hey, I like to do, firsts. Rapid globalization, the height of the Industrial Revolution was the backdrop. The monumental Great Exhibition in London's Crystal Palace drew over 6 million visitors to view international innovations, while the U.S. schooner America won the inaugural America's Cup. I'm a sailor.
I don't remember any of this stuff.
Okay, well.
I wasn't there.
I do not either. But I got to say, 1851, that's when the mutual life insurance company MassMutual was founded. What I love about that is these are companies that have seen so much, not only in our own history, but just market cycles, business cycles. So nice to have back with us Rodger Crandall. He is the chairman, president, and CEO of MassMutual. They provide life insurance, disability, income insurance, long-term care insurance, annuities. They do so much. And he joins us here, as we said, in studio. How are you?
I'm good. Nice to be here. Thank you for having me.
It's nice to have you here. We're getting ready for earnings. C-suite, always important to us in terms of what we're seeing. And I do want to start macro. How do you see it? There's so much coming at investors, citizens, voters, businesses, executives. How do you see the macro?
Look, what we're seeing is the economy's strong.
Yeah.
People are not thrilled about the inflation. And obviously that's news of the day. Waller's speech yesterday, you're seeing the little backup in rates here. So, and then the oil issue isn't going to help any of that. But in general, economy's good. We see our customers are, they're nervous, but they're making money. They're saving money. They're putting it aside. They're thinking about the future. So, cautiously optimistic, I guess.
I really like that Carol went with the history of the company, because the point is that your company has been through so many different cycles and thinking about different types of quote unquote industrial revolutions, right? And that's one we're supposedly living through right now when it comes to the AI revolution.
I think we are.
Do you think we are?
Oh, yeah.
You do?
Yeah, this is a big one. I mean, we can argue about electricity and the railroads and the internet and radio and TV, but this is in that genre of things, I think.
Does it change the way that you think about asset allocation and making sure that you have the money for your clients when they need it?
It doesn't really, like the tried and true, be diversified, equities for upside, bonds for defense. That's tried and true. But I think.
But which equities, which bonds? That's the question.
Here's what's interesting. For the things we do, we're mostly bonds because that's kind of what we do. You want to make sure that you're diversified more than anything. It's really hard to see curveballs, and one of the ways you stay around for 175 years is you just don't blow up. So we're very focused on not blowing up.
Well, and as watchers of the market, we do have blowups, right?
Sure.
From time to time. And certainly as an insurance company, you guys have to think about it, right? Because you have to be there for your policyholders. One of the things I wanted to ask you about, U.S. life insurers held about $807 billion of the most illiquid kind of fixed income instruments last year. So that raised some concerns about overall liquidity and concentration of assets in the sector. Any exposure, and if not, or if so, but what's your view on this?
Yeah. So we have very long-term liabilities, and we monetize the liquidity premiums for our policyholders. You take 0.5% and accumulate it over a lifetime, it's a lot of money. So if you have the right liability structure, we are the right folks to be holding illiquid assets, and we've been doing it since 1851. I'm pretty sure there were not public markets in 1851. So when we started taking in premiums, we were funding, at the time, private assets. And we still have about half of our balance sheet in private assets at any time today, and that's how we add extra value for our policyholders.
So, Rodger, what do you make around the conversation around private assets? I mean, go back a few years, and Tim and I know this from being at Milken and stuff, that's all anybody ever talked about. And then it just feels like in the last couple of years, the tone has changed as we've moved from zero interest rates to higher interest rate environments that make some of these investments, just I'm speaking generally, maybe not as lucrative or as interesting. So the narrative has changed. But as you said, you've been doing this for a long time. So what's the lesson? Is it that a market gets so big that there can be some sloppiness in it?
Look, anytime lots of money flows into any market, you're going to see value get squeezed, and you have the potential for things to get quote unquote sloppy. If you buy something private, our view is you need to be prepared to hold it until it matures, right? Hold it through the cycle. So, look, I started so long ago, we used to call them private placements.
Yeah.
That does not sound particularly exciting, so new names were invented.
Yeah.
But we got drilled into our heads. You buy it, you own it, and you keep it. And that means you need to understand your underwriting.
Which is something we've talked about, that maybe people aren't really reading the fine print and understanding that these are not things that are liquid and you have to hold them for a long time.
I think a lot of the headlines are as much about people maybe not being sure of what they bought and having second thoughts. You've seen a pretty good institutional bid for these assets as the retail bid has moved back here.
I want to talk about some other products and just get the demand sort of side from you. Fixed annuities right now. What's the demand environment that you're seeing right now?
Yeah, demand is strong. I mean, people are hearing the headlines about, boy, the equity markets are fully valued, and look at the potential for kind of volatility. And if you're later in your career and you remember what happened back in 2000, you remember 2008, you're like, I'm not sure I want to have so much equity exposure. So there are different types of annuities. There's lifetime income annuity, which pays you as long as you live every month. Very valuable part of an asset allocation. Think about Social Security and a lifetime income annuity, always going to be there. Then we've got annuities that provide downside protection. So you get some participation in the upside of equity markets, but you trade some of it away for that downside protection. It's effectively an option strategy embedded in an insurance contract. And then you have relatively simple fixed annuities, which I think maybe you were kind of talking about. For customers, these are fabulous products.
Yeah.
They de-risk, and they let you adjust your risk exposure. Whether they're a good issue for the insurance company, we'll see, right? I mean, we've been a little concerned about pricing in that market, so we backed off. We remember what happened in the 2000s when people put in big guarantees, and good for customers, not so good for insurers. And as a mutual company, we are the company, right? So if we write an annuity, we need to think we're going to earn reasonable capital for our policyholders, because most of our policyholders who get those earnings are what we call participating policyholders. They have a whole life policy, and we want that policy to perform. We paid the best dividend in our industry for 20 years in a row. We want to make sure we keep doing that. So we love our annuity business, but we're a little cautious on pricing right now.
So let's talk about the dividend. What are the key factors driving strong growth in your dividend to policyholders? I think you guys have a targeted, let me just look at my notes, a record $2.9 billion
Correct.
In 2026.
Yeah, it's kind of unbelievable. So we started paying, we talk 1851. It's kind of amazing. 31 people pulled $100,000. We had the greatest salesman ever to raise $100,000 back then. The 100,000 is now $34 billion. So we've grown at a 7.6 CAGR for 175 years. right? So whenever in doubt, take out your calculator and run CAGRs. Compounding at 7.5 for a long time is magical.
Yeah.
So it's about twice.
I would take that every year. Sorry.
And the beauty of the insurance piece is it does create that dependability. So what is this driven by? Well, look, rates coming back up has helped us a little bit. Strong returns of our non-participating businesses has helped us. We've had good realizations on things like private equity. But we run a very diversified book to try to make that consistent over time.
I'm just getting a question from a customer watching right now. How do you get customers that are under 30 years old and go under that after that next demographic?
Yeah. Well, look, it starts with our advisors because in a world where you have instant information access with AI and everything, at the end of the day, talking to a person about what matters to you, because what we do is a very human thing. Thinking about what happens when I'm gone, or by definition, we're a multi-generational company. If you don't think about kids and grandkids, it just doesn't make any sense. So we start with making sure we've got a vibrant group of advisors. So we have over 6,000 advisors. We're much younger than the advisory industry overall. So that starts. Most people want to talk to somebody kind of like them. And then it's the old-fashioned things. You know, you're starting to get serious about a relationship. Maybe you're thinking about having kids. And those are the basic things. And it's been that way since 1851. It's that way today in 2026.
30 seconds, AI. Are you playing with it, enjoying it, finding a return on investment?
Yes.
Revenue synergies?
Yes. 75% of our employees use AI every day. We're training our employees like crazy. I say to my employees, I know you're nervous, but you're not going to lose your job to AI. You might lose your job to someone who uses AI better than you. My joke is it's like an amazing Excel spreadsheet. If you learned how to use Excel early, it made you a better employee. Learn how to use AI, you'll be a better employee. So it's going to make us more efficient. It's going to let our advisors spend time with the actual people. And I think it's going to be game-changing.
Did Millard Fillmore have a policy with you guys?
He did not, unfortunately, but
Shame
I
on
wish
him.
he had.
Listen, this was a delight. Come back sooner.
Very
Thank
nice
you.
to see you. Thanks so much.
Great to see you. Enjoy the rest of the summer. Rodger Crandall, Chairman, President, and CEO of MassMutual, joining us right here in studio. We got to get back to what's going on in the Middle East because we're seeing oil prices certainly move.
Yeah, President Trump has reinstated the U.S. blockade of Iranian ships transitioning the Strait of Hormuz and demanded a 20% reimbursement on all other cargo shipped through the waterway. We got Ian Marlowe with us, Bloomberg News national security editor, joins us from Washington, D.C. We also seen the U.S. enforcing a blockade of Iranian ports from July 14th that starts at 4 p.m. Eastern time. Is it fair to call this an escalation?
Yeah, I think so. I mean, I think both sides would say it was the other that escalated, just as they have been doing for the last week or so. I think this amounts to, in Iran's view, this amounts to the U.S. violating what they committed to under the memorandum of understanding that they signed, that Trump signed back in June. This is something where we're probably going to see tit-for-tat retaliation, and I think you're seeing that fear in the oil markets right now.
Ian, we are understanding that President Trump's going to make a speech to the nation Thursday at 9 p.m. Do we know what this is going to be about? Is it in connection with the war, or we don't know?
No, I don't think so. I don't know right now about that, but we've seen him make some comments like that in the past, in sort of some of these primetime addresses. But there's also the chance that it's something domestic and kind of unexpected. Iran is something that has loomed large for him for a while, but I think they know it's not particularly playing well out there, sometimes in the heartland, with midterms looming and everything. So it might not be something he wants to dwell on, in prime time too much, but I'm not sure.
Last question, Ian. I mean, I don't think, the market some days not so surprised about the tensions in the Middle East, stirring up again. Sometimes they look through it. Some days they don't. We know that. Is this all Iran just kind of wielding its power? I mean, what are we hearing from White House sources about who is leading the way on this?
Yeah, I mean, I think this is something that people have warned about for a while. I mean, the U.S. did not want to get dragged into some kind of quagmire in the Middle East like they have constantly accused their predecessors of doing. But this is what we're seeing now, in part, is why previous administrations did not launch a full-scale war against Iran. Iran is a large country with a large military. The U.S. forces are technically superior. They took out a lot of the conventional assets, but you're left with a situation where Iran is close to Hormuz and controls this vital shipping lane. And I think they've retaliated against Gulf allies of the U.S. They've shown they're willing to do that again. And it's something that the U.S. is now kind of struggling to figure out a way to extricate themselves from. And what Trump has just proclaimed that they're going to somehow run the Strait of Hormuz, that they're going to somehow take a 20% cut of oil or traffic going through Hormuz. This is not something I think Gulf allies expected to hear. We're not sure how much of it is, Trump musing in real time, whether this is a fully thought out plan where there's logistics in place and, U.S. Central Command is going to start getting in touch with shipping captains and finding out exactly how valuable their cargoes are, and extracting some kind of tariff on them. It's a very confusing state, but we've been in a confusing state on Iran for some time. And I think the real thing is that, in some ways, a lot of market players know how difficult it is to get, for the U.S. to kind of fully withdraw here from Iran, and they've been expecting some of this stuff to continue for a while at a low boil. And I think we're probably just more likely going to see a lot more of that, in the coming weeks. Because it doesn't look like there's any surefire way to sign on a dotted line and end this tomorrow or even in a month or two.
I'm sure there's lots of national security folks saying, "I told you so." Just going to put it out there. Ian Marlowe, thank you so much. Bloomberg News national security editor there in our DC bureau. I'm Carol Massar along with Tim Stanovic. Let's get to some stocks on the move. Avalon Purnell is with us, Bloomberg stock equities reporter, and we got to start with SK Hynix.
Yes, it's ticker SKHY. They IPO'd, or at least their ADRs started trading last week, but they're dropping now about 8.6% after a really large sell-off in South Korea, as investors are very concerned about this AI trade and whether it can continue.
It just bounces around depending on the narrative.
What about Biogen?
Yes, that's ticker BIIB, currently rising about 4.1%, and that's after Truist upgraded the stock ahead of some Alzheimer's drug data that's expected next week. They expect that maybe it'll be positive, especially given the fact that the company has already said that they're preparing for the phase 3, so the next trial. So they're seeing this as a very good risk-reward situation.
Yeah, really moving the progress along. All right, and this is a name I don't know. I'm not even going to say the company's name, but go take it away.
Yes, Trico, that's ticker TCBK, currently jumping nearly 12% to hit a record high, and that's after First Hawaiian agreed to acquire the bank for about $63 per share.
I feel like your names play into what we talked about too in today's session about a lot of M&A activity happening in a big way. So great names as always. Avalon Purnell, thank you so much. Bloomberg News equities reporter. Check out our Stock Movers podcast, 5-minute episodes of the big winners and losers. You can find it on Apple, Spotify, or anywhere you get your podcasts.
If you're sticking with us on Bloomberg Businessweek Daily, on YouTube, on Bloomberg Originals, on, of course, Bloomberg Radio, we got a great program coming up. Mandeep Singh is going to be stopping by in just a minute. He's global head of technology research. We are talking about this chip trade. Also, what's happening in South Carolina after the sudden death of Senator Lindsey Graham? That's next on Bloomberg Businessweek Daily.